On Friday, the market woke up to a brand new round of Trump tariffs, 25% on iPhones and 50% on the EU. The market didn't like that one bit. The news managed to cool off interest rates, but when stocks and rates are down at the same time, usually someone's lying. If you've been watching the channel, you know that this is exactly the pullback that we've been waiting for though, and now is the time to lock in and not miss the opportunity. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've certainly got a solid red-bodied bar with a pretty meaningful upper wick, indicating that sellers absolutely stepped up towards the highs of the weekly range, pushed prices back down to the opening print because the bar is red, through the opening print for range expansion in the downward direction, and a fairly weak close in the lower third of the range. That's of course bearish. In terms of location on the bar-to-bar count, notice that we do have a nuanced higher high as well as a nuanced lower low, and we've closed once again towards the lower third of not only this week's range but the previous week's range as well. So on the bar-to-bar count, bears are absolutely in the driver's seat, but let's not lose sight of the idea that this is still a higher high in the weekly trend count, right? We can say that this is a high. This is a major higher high in the weekly trend count coming from lows. This was a soft higher low on the weekly. There's plenty of room still for a weekly higher low to pull back from the highest high in the trend count. So am I overly concerned about the bar-to-bar bearish data point here? Not really. We also know that we could still manage to close this gap underneath us, and that would be an awesome spot for a potential weekly higher low. If we're thinking about this from a Fibonacci perspective, let's come in from the bottom of the move up to the high of the move. That would be well above the Fib 38.2, in my opinion, classifying that as an ideal pullback. I mean, it's well beyond the scope of bull flag consolidation. This is like high and tight consolidation. Oh my goodness, gap fill reversal. Let's go to all-time highs, something like this on the weekly. Now, of course, that's a very speculative path that I've just drawn in here. And once again, on the bar-to-bar count, it does seem as though a little bit further of a pullback could unfold here. If we come in from the top of the move down to the bottom, we'll also continue to remember that as long as price is over the 61.8, the odds of a 100% retracement are dramatically increased here. So even if we close the gap and some, moving closer to about 563s, I would still consider that A-okay from a Fibonacci perspective here. What about the anchored VWAPs on the weekly time frame? Let's take a look here at this set. Remember that we are getting confluence at the top of this level. And another thing to point out here is if the gap closes all the way, it's just awesome confluence of a pullback into the previous weekly pivot. If we get a higher low here and use previous resistance, this cluster, as newfound support, that's a pretty classic technical analysis flip. Previous resistance turns to support. It's technical analysis 101. So all set there on that potential gap close, which we know is closer to about 570. We'll get more nuanced on the daily in just a moment. What other reference points might we have? I mean, if the market is going to make an advance, let's say that this turns into a balance range, you're really just talking about the all-time high as being next up in the upward direction. So on the bar-to-bar count, leaning a little bit more bearish for at least a gap close. That's fine. The last thing I'll say here before we check out the volume profile is to just reinforce this level down here. Remember, we have 550, 551. It's this pullback low. If the weekly chart closes the gap and some, and we move underneath that, I would still really be interested in a weekly higher low over 550, 551. It might complicate things on the daily time scale, but for now, not overly concerned with that just yet. Let's quickly check in on the volume profile, and then we'll move this thing right along. Let's zoom out here and see what we're working with. So the high volume zone is really this. In here, what we're doing is using the top of this node and the bottom of this node before the low volume void, low volume void. You can see that we're well above the entirety of the cluster, meaning that the gap close on the weekly could still act as support. If we were to move slightly underneath that, you could parse this out. That's also a high volume node area of support around 560s. And then if we go lower, the bottom end of the gap, or sorry, not gap, but rather this pullback low, right, 550 that we were just referencing, is technically this high volume node before the very bottom of the extreme node, if you will, relative to these two low volume voids. all I'm getting at from a volume perspective is it's totally reasonable that if the market pulls back into this area, it catches itself for support, and then we try to work our way into a higher low on the weekly. This starts to look like an inverted head and shoulders, and then once again, the target to the upside is really just the all-time high, and then beyond that, it's blue sky territories. Let's take a look at the daily time scale. So again, the weekly premise is that it's okay if the market pulls back. Let's go to the daily set here. This is a slightly cleaner version. Let's begin by evaluating the weekly expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner here. If we're contained by the upper bound, the number's at 592 flat, and that does technically imply a lower high on the daily trend count, so that is something worth noting. If we're contained by the lower bound, the number is at 566.28, and to me, that's an awesome spot for a potential higher low on the daily trend count, which really leaves us with a pretty neutral expected move here with the condition that the weekly trend is up. The weekly can easily find a higher low. I would go as far as saying this is still a bullish expected move for the week. Why? Well, if we consider where the lower edge of the weekly expected move is, it's the full gap close. Remember that this is the China gap. This is, hey, we're going to make a deal to make a deal. China tariffs are coming down for a 90-day pause from 145% to 10% plus the 20% fentanyl tariffs. That's this gap back here. The lower edge of the weekly expected move is suggesting, and keep in mind it's a shortened holiday trading week, markets are closed on Monday. If we support there, that's an exact gap fill reversal. We're already starting to get some support off of the daily 200 SMA, the green moving average on our screens. And as we talked about on Wednesday, we saw the pullback develop really on the Wednesday afternoon session there, rejecting Tuesday. Our forecast was, okay, we're probably going to get further downside. That ended up playing out quite nicely. But what did we say, right? We're looking for either the top of the gap to act as support here, which so far it has with confluence at the daily 200, or if the market rolls over, let's say that there's a stronger daily lower high here, we form some semblance of a daily double top. That's okay. I'm not worried about that. Underneath the neckline, I would be thinking about, can we go gap fill reversal off of the 567.75? This is where we have a little bit of a hesitation here, but then Brigade bolting back over 577 should in theory target the equal high, which is much closer to here, around 595 on the daily timescale. So I'm still bullish on the thesis that this is a higher low pullback in the context of an uptrend. For all of those who didn't watch Wednesday, we have lows, we have major higher lows, soft higher low, soft higher low, soft higher low. Remember that these are soft because the hourly trend never flipped it down, the hourly trend never flipped it down, the hourly trend never flipped it down. Of course, during this pullback, the hourly trend has officially flipped to down. So therefore, if the market supports the daily 200, this is a firm higher low in the trend count. We would be pulling back from the highest high in the trend count, and the trend would remain in the upward direction. So 577 is still a critical watch here as of right now, the Friday structure. Yeah, we gapped down, but let's talk about this actually on the hourly time scale so you can see it. This is where we bring up some of those more nuanced levels. The market gapped down on the news about the tariffs and the 50%, 25%. This is kind of a step in the wrong direction in terms of making progress on free trade deals. But we gapped into the daily 200 SMA. It immediately was bought up. There's some consolidation over the 577. And then what happens? Right? The market technically closes the gap, Friday's gap, into the Thursday session low. Now into the afternoon, we back off of that level, so the hourly trend has not changed back to up yet. However, this is healthy activity. If stronger sellers were really going to enter the market and this was going to be, oh my goodness, another round of tariffs, we're going back to the April lows, it's going to be nonstop, just ugly, 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 you would have gapped to the daily 200, you would have rejected 577, this is the China gap, remember, you would have rejected that, gone under the opening print, underneath the overnight low. We talked about that on Friday's pre-market prep. And then if there was going to be some sort of downside action, the market should have attempted to close the gap to the downside. The fact that the market opened on a gap down into the China gap, had the possibility to reject 577 and did not, tells us that stronger sellers are not getting active with a catalyst on a gap down. Think about that for a second. Right? This entire rally that we've seen in the upward direction, even on these mild pullbacks, consolidation days, whatever, there might be some bearish divergence in the sense that new money buyers did not support this move up here, but we have not seen stronger sellers at the exchange level. The open on Friday was a perfect storm for sellers to get aggressive, and they did not. That is a sign that I am taking away from what happened there. Once again, the gap was able to close overhead. Buyers did their job. Sellers did not do their job. unable to close the gap to the downside, the China gap. Now, one more time, I don't want you to misinterpret that the hourly trend is still down, right? So in the short term, we have highs, lower highs, lower highs. This is still a lower high on the gap fill reversal, right? This is still a possible threat for a daily lower high underneath this overhead supply. But for now, my base case on the hourly time frame, and we'll get into some pathing here, is if we can hold up over 577, this starts to get me back on the long side. I would really be thinking about this as a retest of the overhead supply level, this failed break over the daily zone that we were just talking about, right? 588.75 for those who missed it. Let's go back to the daily real quick. We talked about this on the Wednesday session as well. Reason it's 588.75 is because that represents this overhead supply. That's why it's labeled OHS. Going back down to the hourly time scale, right? The argument is if we can hold here, great. Daily higher low is forming. Brigade bolts over the Friday high, give us an hourly trend reversal. You have lows. What we would be seeking is a higher low here over 581.50. Walk up your first target, 585.50. Beyond that, we look for 588.75. That's what would happen if a daily higher low is going to persist at 577 flat. Staying over the top of the gap, supporting over the daily 200 SMA. Beautiful confluence there. If the market's going to be a little bit weaker, the hourly trend will not change, right? We'll get some sort of consolidation. We will not break out over 581.50. This will persist as a bear flag per se on the hourly time scale, and then simply Brigade bolts into the gap below. So under 577, really under the daily 200 SMA and Friday's open at 575.50. That's a very dim level on the screen, but it's there. If we get underneath that, that's where I would really expect more of that gap to close. And as we mentioned on the daily time scale, even if the gap closes, this is where we're looking for that higher low once again. So as we approach 567.75, I'd be thinking about, okay, can this turn into a double bottom? Can we rotate back up to the top of the gap? Can we get, so let me put an arrow here. Can we get through the top of the gap? Can we then Brigade bolt here? I'd be fishing for longs on 577. So the thesis hasn't really changed. The base case is still alive that the daily trend is up. The hourly trend has flipped to down. That's in service to setting a firm daily higher low, not just soft higher lows on the daily. And if we can see pullbacks, if we can see the buyers step up and really hold 577, great. Higher low, first hourly trend reversal on a Brigade bolt here, right? You could maybe make the argument that this sort of turns into double bottom, right? So over the neckline here, once again, 581.50, I want longs for risk and reward ultimately up towards that overhead supply zone at 588.75. We'll reevaluate when we get there. Do we see buyers just smash right through, or do they pull back? Can we set another daily higher low over 581.50 at that point would be the next watch. So the continuation might be if this is your double bottom, something that gets here. Let's say that the market pulls back. The next higher low that you would want to see, the major one, would have to be lows and then higher lows, right? We'll take that in stride when and if we get there. But for now, the first half of this pathing, let's say this, is primarily what I'm after. If the market does not turn this into a double bottom and it just consolidates out into a bear flag from this perspective, fine. Underneath Friday's opening print, lower high inside the gap range under 577, I think this rotation is reasonable. When we get here, I'm not overstaying my welcome on shorts. I am looking for longs. It could be inverted head and shoulders. It doesn't matter what the pattern is, but I'm looking for this back to the upside. Risk and reward back to 577. So are we not trading shorts? No, of course. You can trade shorts from point A to point B, but I do believe it would behoove you to understand the context of the market that you're trading in. You could trade the short A to B, but at point B, once again, I would not overstay my welcome. I would trim at minimum 3/4 of the position there short and then look for a reversal, right? You probably have a trailing stop where if you reverse, that maybe just is literally a reversal of the position. You close the shorts, open longs, and then retarget the 577, right? So that's how I'm approaching the market. I probably would be more open-minded to just wrapping up the entirety of the position at point B and really seeking that higher low, just because I'm I don't think I'm over-indexing on the daily analysis here. So there's a really strong trend in the upward direction. This is the first offering of a higher low pullback. Very open-minded to locking in, as I said in the intro, right? That's what the kids say these days. Lock in. I'm interested in locking in at the lower edge of the weekly expected move, top end of the previous balance in here, and I really want to see whether or not buyers step up. Let's go back to the hourly. I'll show you the intraday anchored VWAPs. This is insightful. From the perspective that, once again, if we can crack underneath this kind of, let me zoom out so you can see where it's anchored to. It was this first gap up that kicked off that really brutal consolidation in here. But if we stay underneath that, right, fine. The gap can close to the downside. If we're over that and breaking out of that double bottom neckline I was just referencing here, over 581.50, you're over the anchored VWAP. Once again, these would act as resistance. I would maybe evaluate at 585.50, but ultimately the major level to the upside is 588.75, right? If we come in here with some Fibonacci's, I think the only interesting fib that's left, obviously this is a 100% retracement. We don't need that one. But if we come in from the high to the low of this move, what we'll learn here is that the 61.8 is confluence with the 588.75, worth carrying forward as a reasonable resistance target. If the market pulls back off of that, once again, worth reevaluating at that particular level. Right. Last Fibonacci, I suppose, that might be useful. We've already done on the weekly from the low to the high, but let's come in from this low up to the high to just reinforce one more time that the gap fill reversal over the 567.75, it's well over your fib 38.2. You're still over this solid anchored VWAP. This one back here is the all-time high anchored VWAP. This one down here is obviously the low from the tariff turmoil anchored VWAP. You're over a number of reference points. If you just think about this from, using simple counting perspectives, how many anchored VWAPs are you over versus how many are you under? Right? There's 2 above and there's 1, 2, 3, 4, 5, 6 below. I mean, certainly still reasonable to say that the buyers have the edge in this current market. Let's take a look at the market internals, what's going on at the exchange level. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. You could see that on Friday's gap down, there's really not that bad of volume flows. I mean, you would think with the size of the gap, remember, this was a 60-point gap down in the ES futures, you would think that volume would not really have a chance to recover into the afternoon, but yet it does, right? So once again, stronger sellers had all of the ingredients for a major move to the downside on Friday, and it simply didn't happen from a volume perspective. The advanced decline line trended higher towards zero, the zero mark. And the argument here is not to say like, oh my God, it's so bullish, the market's got to go make new all-time highs. The evaluation, the question we always ask is whether or not the move is being validated in the particular direction that's unfolded. So to the downside, do we have stronger sellers? I have to say no based on volume. I have to say no based on the advanced decline line. I have to say no based on the index score. I have to say no based on the cumulative tick. On Friday, there was nothing, right? So sellers aren't really getting the job done here on the gifted gap down open on that Friday session. So in my view, yeah, we've been a little bit divergent at the highs. We know that we didn't really want to long the highs, but that's fine, right? From a trade location perspective, it's all set to pick up on the divergence up here and say, okay, we're not buying the tippity top of the move. But as the market gaps down and pulls back into potential support and sellers are not there at the exchange level, why would I not take my shot at the potential for a higher low and aim for the market trend to resume in the upward direction? So that's what I'm seeing. That's my supporting evidence on the exchange level. Let's take a look at the market profile. If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. What do we see here? I mean, obviously value has progressed lower throughout the week. Here's Monday. Here's your Tuesday session. Wednesday was overlapping still to the Tuesday session. Point of control was certainly inside of Tuesday's range. But from there, you get clean to the downside on Thursday, clean to the downside on Friday. So just like we were looking for the hourly trend to reverse out of the spider's cash, I mean, value, if it starts to break clean back in the upward direction like this, that would be another good signal to say, okay, this is looking a little bit more firm, like a bottom, right? If we zoom in to the Friday session in particular, the other thing I'll point out here is that A period has great excess on the lows. This is not a poor low. It's not weak or mechanical in any sense. So to me, it's much more secure. What other nuances to pull out from here? The point of control was midway through the range on Friday. I guess maybe that would just indicate it was a pretty balanced session, although yes, technically we did trend higher to close the gap all the way. It's not like value was slammed into the highs. Point of control was not at the highs. I think that's normal considering some of the circumstances as well, just from a more, what would you say, tactical perspective. Does anybody want to hold risk over a long weekend, especially on the heels of new tariff news? I don't really think so. Some de-risking there, not really wanting to commit prices at the highs or the lows, just kind of a neutral session. It makes sense to me based on the profile. So nothing major to glean from nuances in here. The only thing I'll say, if we zoom out a little bit on this, is we can just see the China tariff, China deal, China, whatever you want to call it, gap here. There's a little bit more of a look into it on the ES futures. And one more time, the only thing I would set forth is just if we had stronger sellers moving into the gap, you would think that on the Friday session, the ideal outcome for sellers, I'll use a blue box here, cyan if we want to be precise in our color terms, that way it doesn't overlap with the white. you would think that an open here would give the sellers the shot for a rally, reject the top of the gap, rotate through the opening print, under the opening print, whatever, even underneath the overnight low, which is this gray move right here. You would think that this would be the base case for stronger sellers. And as we've seen, if we just sort of map this out, and you can even see it, let me just come back in with this as the low, where was the point of control on Friday? It was over the gap. Sellers were unable to close the point of control inside of this no man's land, which in my view, I'm carrying forward as a bullish data point. So that's what I've got for you. I think it's a fairly objective take on the market data points that we have in front of us right now. This is not me subjectively saying, I woke up on the wrong side of the bed and I want to be bullish all of a sudden. No, I mean, we're in an uptrend. We don't really have stronger sellers, and hopefully I've proven it to you by looking through these data points in the episode together. Let's move along to the QQQ NASDAQ 100. Let's see what's happening here. Let's just give a little reset. Go to the weekly time scale, and let's take a look at our classic indications. What do we see candle structure-wise and location? Let's take a peek. Of course, very similar to our S&P 500, an inverted hammer. Sellers step up towards the highs, push prices to the opening print. Through the opening print, we've got a red-bodied bar, so we close at the lows of the body. We don't have, on the bar-to-bar count location-wise, a lower low. We technically have a higher low and a higher high. In a weird way, that's technically bullish. And you've also got a close here relative to the previous green-bodied bar over the opening print. So you don't have nearly as much relative weakness on the QQQ as you do over in the S&P 500. I would make all the same arguments from a general trend perspective. You have lows, you have higher lows on the weekly time scale. From here to here, you undoubtedly have a higher high. That means that a gap fill reversal offers you a higher low. You're over the weekly 50 SMA, the blue moving average. Or even if you move down to here, it's a little bit deeper, it would be more uncomfortable. But something that looks like this and then recovers, I mean, my goodness, that's also an opportunity from here to here. Absolutely a higher low pulling back from the highest high in the trend count from the weekly perspective. So no major concerns. The analysis still stands that the buyers are in control. Let's come in from the top to the bottom with a fib. We're over the 61.8. If we close the gap and stay over the fib 61.8, the odds dramatically increase for the 100% retracement. Let's come in from the bottom of the move up to the top. If we could get a click. Thank you, Thinkorswim. There we have it. And again, the gap close is over the fib 38.2. I would just point out that if we do move to closer to the 470 mark, this previous low, it's a small overshoot of the fib 38.2. I would carry that forward as being a little bit more of a neutral data point. And once again, probably complicates the move back to the upside. We'd have to, it's just not going to be as clean. You'll have to battle through some consolidation perhaps. And if it does this back over this level, that becomes a little bit more compelling. But once again, this is a very speculative path. Let's take this one step at a time. We still have a shortened 4-day trading week ahead of us where maybe we pull back to close the gap, and then maybe there's some reaction off the weekly 50, excuse me. If the market's going to remain contained inside of this bar because we did not produce a lower low, you're just going to get weekly consolidation up here, and that's pretty much setting up price acceptance higher, a lack of acceptance, a lack of willingness from sellers to keep prices in this range. I would have to think it turns into a balance, and the next step would be looking for some sort of Brigade bolt over the highs, literally into the all-time highs on the QQQ. Let's take a look at the anchored VWAP, see if these are supporting any of the claims we're making. We're above the entirety of the cluster. The cluster is going to start slowly providing super support confluence at that key area. Just FYI, it's right around 492 on the weekly for the gap close there. So we'll carry that forward. The daily gap close is slightly lower, but that is looking good. From a VWAP perspective, we're above the entire cluster. They're acting as support underneath us. How about the volume profile? We know that there's one major node on the QQQ versus multiple nodes like the S&P 500, and once again, we're above the entire node. So I have to maintain a bit more of a bullish stance here on the higher time frames after setting a higher high with plenty of opportunity for a higher low pullback. I'm not seeing any reason to be an aggressive bear. I mean, if you want to use this as a sign to say, okay, we looked over the previous week's high, we failed back into the previous week's range, maybe there's a pullback. If you're not operating on the weekly time scale and you're like a daily trader, you're a day trader, whatever, underneath last week's low to close the gap is a very reasonable thing. Like, don't get it twisted. It's okay if the market continues to pull back. That is fine. It is not going to hurt the weekly trend thesis. Let's come down to the daily time scale. Let's go to the QQQ. And let's take a look here. On the daily time scale, I don't think that I did not make the daily set here. I've got to remember to do that like we did in the S&P. But for now, we can see very similar. We have ourselves a high that was set after, let's just count the trend, higher highs, higher highs. We're pulling back from the highest high. We finally have an hourly downtrend, which is helpful. It's in service to setting a firm daily higher low, not these soft higher lows here. This is a little bit more firm. This was soft on the opening pullback from the China gap up now 2 weeks ago. So firm higher low pullback is on the table. One thing that I will say is a little bit more compelling out of the QQQ is just using this overhead supply zone. That's 509. The market did start to reject that a bit on the Friday session. Now, what you'll notice here right out of the gates on the QQQ, and we talked about it on the weekly chart just a second ago, is some relative strength compared to the S&P 500. Look at this gap from the China move. I mean, we did not open in the gap. The 200 SMA is still towards the bottom of the gap. Just not even close. It's not even close. So a couple of things to make note. If the NASDAQ continues to reject 509 on the daily time scale here, and we move to the top of the gap, I would expect that the S&P starts to test the gap again. If the NASDAQ looks into the gap, fails to close it all the way, finds acceptance above, and then rotates back to the upside, even if the S&P is still in the gap, I would want to be seeking longs there, not shorts. If the NASDAQ is over its China gap at 501.50, I want longs in the S&P 500. Why? Because the tech sector represents over 30% at this point, more than a third of the S&P 500. So why would I seek to fight the relative strength in the tech sector in the S&P if we're getting this situation in the QQQ? And again, you can already see the relative strength. We did not interact with the gap here. If we move it on down to the hourly time scale, and I think everybody's all set on the daily, right? We know that it's really about the top of the gap, 501.50. The gap closes down here at 490.50, Lower edge of the weekly expected move is inside the gap, not even suggesting a full close. The daily 200 will be confluence. That's 495.69. Upper edge of the weekly expected move is an equal high back here, a little bit more bullish than the S&P 500 at 522.79. Let's move down to the hourly time scale, and you can see that the NASDAQ has been in much more of a balance range here. On the Friday gap down was really the first major change in trend via moving outside of this hourly balance range. So the hourly trend is officially down, right, which is helpful for setting the firm daily higher low. If we're thinking about the outcomes here, I would say as long as price is underneath 515, the bears kind of have some edge here, keeping overhead supply on the hourly time scale, weighing down for a potential lower high. From there, if we were to Brigade bolt back underneath 509, that's where I would seek shorts, right, because this is the daily overhead supply level, to come in to test the top of the China gap. That's 501.50. If the market does not get the rally first and instead is just consolidating here, I think it's a no-brainer short underneath 506 into, on a Brigade bolt of course, internal 506 into 501.50 and reassess when and if we get here. If we start to see buyers step up, so let's say it starts looking like this, and then we see, internals are strong. We see, some decent looking lower wicks on the higher time frames in here around 501.50. I would seek longs off the top of the gap. Can we get some sort of risk reward like this back into the overhead supply zone, 509? And if we can balloon runners beyond that, the next target's 515. Something along those lines. Absolutely a trade location I'm highly interested in exploiting longs at, not necessarily overstaying my welcome on the short side because of the strength of the daily trend. It's still up. We know that we're seeking a higher low in a daily uptrend. Let's not freak out and panic because, oh my God, the market's been down a couple of days. I mean, zoom out. What has the market been doing ever since the tariff turmoil lows? Straight up, right? A little bit of a pullback to offer a stronger entry point, stronger entry location. I think we could all welcome that with open arms, right? If the market moves under 501.50, so let's say we get this situation here, overshoot lower high inside, I would start watching the daily 200. And the reason I would do something along these lines is simply because we saw that in the S&P 500, we opened in the gap and the sellers were unable to close the gap all the way. If the NASDAQ looks into the gap and the sellers cannot close the gap all the way, let's say we support over the daily 200, this is going to be a difficult trade to catch because you have to sort of trust it in no man's land. I would say here is where I would be all aboard the long train. If the gap does not close all the way, if the daily 200 supports the market, if we can get back over 501.50, count me in, coach. I want longs. That's it. Game over. Sellers couldn't get the job done. They could not close thin structure to 490.50. Not happening. get me in long here. I'm going to ultimately retarget the top end of the move, the equal high on the daily time scale, probably in the longer term account, right? I'd be fishing for a stronger long position there. But generally, my bias for the market's propensity to move would absolutely be up on a hold over 501.50. If the gap closes all the way, fine. Sellers did their job. This, right? This. I'm still interested in a gap fill reversal. Can I find longs here? And now my first target would just be the 501.50, and we would reevaluate when and if we got here, right? In a picture perfect world for buyers, it's a Brigade bolt back above. In a not so picture perfect world, it turns a little bit sloppier. Let's just draw this in a little bit more simple, right? Like this. We chop around in here, pull back, right? And then maybe it comes back down. This is where we would have to reevaluate. But as we've been saying as a theme for today's episode, we've got a shortened 4-day holiday trading week. Let's take this one step at a time. If the pullback extends, looking for buyers, right? Let's take it one step at a time. We'll evaluate this situation when and if we get there. But for now, the base case lives on. We're looking to buy higher lows. Let's take a look at the intraday anchored view apps. You can see we have support right here at the low of the Friday session from the anchored view app to this. Similar gap up to the S&P we were looking at. These two will act as overhead supply here once again. If the market rallies and rejects 515 first, that's fine. We know that the hourly trend can remain down there with a lower high. If the market rejects that and pulls back, we know what we're looking for. You could try shorts risk reward to 509. Under 509, it's this, right back to the top of the gap. All those downside outcomes we were just talking about. The situation that I don't think we've covered maybe enough is if the market pokes into the 515 range and accepts in here, it complicates the issue. I really don't want to be a new money long inside the consolidation box. I would think, okay, this is going to look like a higher low, a firm higher low in hindsight, but the place to execute on that on the long side going forward is probably the Brigade bolt over the top end of the range to bring in new highs. That way, at least we can manage risk like this and look for some potential breakout towards, not quite the all-time high yet, but 533.25 would be the next target overhead. So this would be a very disappointing trade outcome for the upcoming week's worth of trade, just noting how choppy and sloppy this range has been. That's what I've got for you on the hourly time scale. The fibs aren't really going to be of much help to us. We can just throw them on there quickly to be congruent. If we do this, right, not of much help. Technically, we're under the fib 38.2 here, so call this bear flag consolidation. Fine, not really of much use there. Let's zoom out on this. Let's come in from this low. We already did the weeklies from the major low. Over the gap fill reversal is still over this fib 38.2, and I guess that's kind of the last I would reinforce from that perspective. Let's take a look at the market internals, for the NASDAQ side. You could see the similar picture, right? You don't really have strong volume outflows on Friday. Sellers aren't really firm there. Same thing with the advanced decline line trending higher, not quite as close to the zero mark, but no brainer is the cumulative build out of the tick Q, just not indicating that there were any stronger sellers at the exchange level on that Friday open on the gap down. So all set from this perspective, no stronger sellers at the exchange level. Let's move along to the NQ market profile. Let's get this front and center on the screen. So this is the week's action. You can see that we have value was actually overlapping. It was outside value basically on the Wednesday session. Lower, not clean lower, but overlapping to down on Thursday, clean lower on Friday. So once again, if we are looking for a reversal back to the upside, a good tell if it's going to give us that complicated, annoying situation back inside the overhead supply. If value on, let's just say Tuesday or Wednesday breaks clean to the upside and accepts in this range, it's going to be disappointing. It's going to be frustrating to trade, but you should carry that forward as being a bullish signal, right? You should not overstay your welcome on the short side. One thing I will point out about the NQ market profile is we do have a poor high from the Friday session, and the gap technically didn't close quite all the way. So buyers could have done a little bit better up here towards those highs, but if anything, it just means we carry forward that if we test Friday's high, we should look for that to break on the first test because it is poor in nature. We do not have an excess high there. We do have an excess low, which is much better to secure the auction at the lows. Let's move back on over to the platform. Let's take a look at our good friend, the Rusty Russell 2000. Let's see, all 2,000 of them. Here we go, weekly time scale. We know that there's some pain over in the Russell, simply noting that, let's grab a 5-year chart here so we can see it a little bit better. If we take a look at the 5-year, right, this key level is like do or die right here, right now. Now, if you look at candle structure and location, let's be congruent in the analysis. Let's not skip steps here and omit this part of the talk. You can see we've got a red-bodied bar. Yes, we've got a little bit of an upper wick, a little bit of a lower wick. They're more equidistant than what we saw in the S&P and the NASDAQ. It is technically on the bar account a lower high and a lower low. We closed underneath the previous week's range, but we closed the weekly gap. We're testing the weekly 200 SMA, and we're testing, most importantly, this trade location right here. Is it possible that the small caps could produce an inverted head and shoulders to kick off a more firm reversal from, I would even argue, the monthly time scale at this point, trying to stay over the hammer high, trying to stay over the monthly 50 SMA, the weekly 200 SMA, this key level, the top end of the balance range from back here, acted as a monthly high or low in these lower wicks. Can we stay above that is really the key question to ask and answer. The structure is bearish, but the location is technically bullish. So with that, I think, we can throw on a couple of additional study sets here to get a little bit more information. We're inside of the VWAP cluster. We have some supporting underneath us. This high, the lower high that was set here, anchored VWAP, is right there for potential support. If we could hold that with the confluence of the monthly 50, the weekly 200, the key level that we've just been referencing, if we could hold that, I would maintain a slightly more optimistic stance for small caps, which in theory translates to an optimistic stance in the S&P 500. Remember, if the market was overly concerned with inflation, causing rates to have to skyrocket basically, then small caps, and don't get me wrong, they've taken a beating so far, but they would be on the lows, threatening new lows as rates are, the TNX at least, towards the highs near that 4.8 mark. So the fact that that's not happening, the fact that we're off of these lows, I'm trying to keep a little bit more of an open mind, an optimistic mind, that it's possible the market's not overly concerned about the inflation issue from these tariffs just yet. And we'll get into that as the show moves on as well. Let's take a look. Let me just go back to our 50 and 200. That way we could take a look at some cleaner Fibonacci's here. From the lows up to the highs, we're over the Fib 38.2. That would classify this as bull flag consolidation. So no concerns from that perspective. The issue, of course, is if you come in from the highs down to the lows, it's do or die. Right at the Fib 38.2, it's a must hold. If it breaks, technically we're back down inside of bear flag consolidation zone from this perspective. So I think it's very clear. 200, literally the weekly 200 SMA, 200 the round number, the top end of the balance range from the weekly, the monthly, very obvious trade location here for IWM that must hold if we're going to remain optimistic for the broader market overall. The final thing we'll look at is, of course, our volume profile, and this thing is all sorts of funky, but as we know, this is not, it's aligned with like the highest volume node in this as a big range, but generally this block, it would be best if we could clear these weekly highs and kick off some sort of reversal up towards this, right? So the top end of this volume node is really the top watch. If we're in this range, you could see it's choppy sloppy through this. I wouldn't read into it too much other than can we just make sure that we hold the bottom end of the high volume node, all this key support that we've been referencing on the higher time scale. So that's that. Let's move on down to the daily. I know for a fact I did not parse out the dailies on this IWM. Let's take a look at the weekly expected move first, and then we'll keep this thing moving along. Upper edge 208.29 equal / slightly lower high. If we're looking at the lower edge, it's at 196.83. The issue with that is that it's a breakdown underneath kind of the key hold. This is that weekly zone that we were talking about. It's close to that 200 cluster. It's where our threat is, right? So if we could hold that, looks good. Daily 50 SMA, lower edge, the weekly expected move. That's 198.25, 196.80s. If we're supportive in here, I think it's still a higher low, right? We have lows, firm higher lows here. Apologies. This is a firm higher low. We did flip into an hourly downtrend there. We did flip into an hourly downtrend here. If we can hold this, obviously we're in an hourly downtrend here. If that's a higher low, all set on the daily time scale, all set on the weekly time scale, all set on the monthly time scale perhaps as well, so long as that key area holds up. I mean, I feel like a broken record, but so what do they say? All roads lead to Rome. Well, in the IWM, all roads lead to 200. If you can hold 200, things are looking okay here on the daily time scale, weekly time scale, monthly time scale. In terms of the gap on the Friday session, what I find most compelling about this is, in theory, small caps might be the most sensitive to the new economic data. Where did small caps close relative to what we saw in the S&P and the NASDAQ? Small caps closed on Friday back inside of Thursday's range. Look at this close inside of Thursday's range. That's a little bit more of a bullish data point as opposed to a close the gap and then close weak with an upper wick like what we saw in the S&P 500 where the bars looked like that, right? So some small divergence here that, in my view, continues to keep me open-minded to that long side more so than changing my tone and saying, okay, let's throw in the towel. It's got to go to zero. Markets are going to crash, right? So that's the daily. Let's go to the hourly. Let's build in some quick pathing here real quick. Obviously, just a balance range overhead means even if we rally A lower high can be produced on the hourly time scale underneath 205.85. If we pull back, the next idea would be, does this turn into an inverted head and shoulders? Do we hold over 203? So on the upside, if this breaks out, if this relative strength we've been referencing on Friday is going to carry forward into the early parts of this week, a rally here, yes, first thought is a lower high, but then second thought is a higher low here to change the trend, right? Something along these lines from the hourly, and then from there, a range rotation into 209.25 would be all, full steam ahead, S&P 500 breaking these highs, rock and roll. We talked about that from the weekly. If the market consolidates down here, that's a little bit more of that tricky spot where if we pull back, I would continue looking for opportunities to find buyers towards this 198.25 200 zone. You guys may or may not know me. It depends on how long you've been around the show. I'm not actively trading the IWM. I'm using this as a bellwether gauge for the S&P 500. So I'm not fishing for longs here, but I'm watching it very closely to see whether or not buyers step up. Thus, I can build confidence in the S&P 500. Let's take a look at the intraday anchored view apps. We're below 3 as opposed to just 2 like some of the other indices. You can see that we still have, what would that leave us with, 5 underneath us in here. If we can get above, you're going to get confluence out of this one near that 205.85. If we're below, this is the all-time high, I believe. Let me double check on the small caps first before I say something wrong. Not quite the all-time high, so that's kind of an arbitrary, it's maybe the scene of the crime. It's just before the all-time high out of smalls. Scene of the crime breakdown for sure, right around that area. If we could support above it, it's kind of confluence with the daily 50, the 198.25, so maybe useful from that perspective. It's absolutely still the day where the S&P and the NASDAQ produce their all-time high, so even if you want to carry it forward from that perspective, kind of useful, clustered in there as a key one near that 198.25. So we're all set on that. We could come in quickly with the fibs from the top of the move. Let's get the top down to the bottom. 61.8, reinforcing that 205.85, all set there. Let's move into the Russell side of the market internals. Let's see what we can see here. No strong volume outflows on Friday, which makes sense. Remember, this was a stronger day to the upside, closing back inside of the Thursday range towards the 0 mark on the advanced decline line, and the cumulative build actually closes a little bit more firm on the positive side versus flat. I mean, don't get me wrong, it's not a strong build, but it's positive relative to the flatness we saw on the NASDAQ as well as the S&P. So the key question, just to recenter ourselves on this style analysis, is do we have stronger sellers stepping up on the gap down, trying to take advantage of the market and a catalyst? The answer is a resounding no across all 3 of the broad market indexes that we use. Let's take a look finally at the Rusty Russell market profile. Huge A period excess on the lows, huge poor high, flat across the top there, J and L periods, even just like as we continue to zoom in a little bit, that L period, 1 TPO of excess, to me, would need repair through that high. You could just see if we go back to the hourly time, even let's just stay on the futures here. Look at all these equal highs into the afternoon. That's the improper end of the auction. I would expect that to break if tested in the future. Once again, we want excess on the highs. We want excess on the lows if it's going to secure the top or bottom of an auction. Let's go back to the market profile. Any other nuances to point out? The value was not clean to the downside on Friday, which once again makes total sense considering where we closed on Friday relative to Thursday. One of the targets that you might carry forward out of smalls would actually continue to be the single prints overhead from the Wednesday breakdown. That's over 2070, brings you into the bottom of the upper distribution at 2082. So you've got about a 12-point rotation available there to the upside out of smalls if that move is going to take place. Let's jump back over to the platform. Let's take a look at the performance of our S&P sectors. Let's just reset some of the screens here, and let's have ourselves a look. Who was leading, who was losing, and where was the weight? Of course, we have a red week, so it's not a shock to see everything down. Energy leads to the downside, followed by real estate, then financials, then healthcare, then the tech sector, then semiconductors. Why am I pointing out, the top dogs there? Just because it's not like the semiconductors were down 5% and the market's pulling back. This is a mild pullback out of tech, out of the semis. It's nothing detrimental. So from a rotation perspective, as the market pulls back here, it's not being led by the heavyweight sectors. Like energy is leading the pullback here to the downside, the most volatile to the downside. That's not a huge concern, in my view. The leaders of the week, so to speak, by being down the least, are the consumer staples. Bonds obviously don't count as a sector, but then we have communications and utilities. A little bit more defensive there for sure, outside of communications, staples and utilities, absolutely. But again, the market's pulling back. Would we expect them to outperform to some degree? Yeah, perhaps. So sector posture, not really a big deal. As we look at some of these structural charts, energy back inside of this range, I think obviously on tariffs, as well as some of the bond auction stuff that happened on the Tuesday afternoon, Wednesday afternoon was when that took place. Not a shock to see this sort of come in a little bit, the energy sector there, noting that, you could maybe build the argument. Let's go to crude real quick, CL. Let's take a peek. We haven't looked at this in a little while. The lack of breakout here, right? This is your Wednesday upper wick, right? Things were going fine seemingly before the bond auction. Maybe R word, recession coming back into play, global demand slowing down. It's just in this range. I would say the biggest concern is if we lose the 60 handle. Everybody's been watching 60 very closely. If that comes below 60 and starts to move aggressively lower, breaking down from, let's just call this a bear flag, yeah, maybe we can reference the recession narrative, but for now, it's not really the case. Let's move into real estate, rate sensitive, no brainer that it came down. It's real estate is such a lightweight sector that I don't think it's going to move the needle much. The thing that we just want to continue to focus on is the wealth effect, so to speak. If you see real estate making new lows because rates are through the roof, you might get people buttoning up some spend, feeling the wealth effect, basically their home values coming down, so to speak. But that's not really a major concern right now at 41. Let's move into the XLF financials. We see a clean opportunity for a higher low. The theme that I would really encourage us to pay attention to in the heavyweight risk-on sectors is there still an opportunity for a higher low, or did last week's pullback totally destroy the market? We know that, first of all, if we could hold this, fine, no problem, 49.75. But we also know, as long as we're over 48.65, that's kind of my major line in the sand out of financials. We could easily get, now that we've produced this major higher high, a reasonable higher low here, build a new uptrend to the upside like that. Great. That could easily stem from the clustered moving averages around this 48.65. So all set on the higher low thesis. It even looks great as of Friday with the close back inside of Thursday's range relative to the index, right, where the S&P closed underneath. Let's take a look at healthcare. UNH has been just totally beating this thing up. One of the things that I'll continue to carry forward is that if this can hold, and it's like right here, right now, do or die, if this can hold 129.25, I would start thinking of it through the lens of look below and fail. If we can hold, in theory, the target is always the top end of the range. Of course, you'll have to target this and this. You'll walk your targets up. But the point being is we should never forget the healthcare sector, although it's defensive, it's the fourth heaviest weight sector in the S&P 500. It's very difficult for the S&P to have a full-blown risk-on style look, or just like, what would you say, straight shot higher, new all-time highs, everything is firing on all cylinders if healthcare is not participating. I love the little hammer candle here on Friday. If we can stay over that 129.25, that, in my opinion, breaking Friday's high, the next big step would be getting a higher low or price acceptance over 131.75. That would reinforce the bullish narrative for the S&P 500. Let's move along to the tech sector. Again, key question to ask and answer here is where are we pulling back from, and is there still an opportunity for a higher low? We're pulling back from the higher high, and yes, there's absolutely a chance for a higher low. You've got a non-test of the gap below. You did not move into it. You supported above. You supported over the daily 200 on Friday. If you can get back over 226.75, great. Back to the equal high at 235.75. That's bullish, of course, for the S&P, setting a firm higher low. If we move into the gap, no problem. Can we go gap fill reversal here and then build it out like this? Absolutely. That's 219. All set, higher high pullback, offering the possibility of a higher low. Let's move to the semiconductors. What do we see here? It would be best, I'll admit this one, semiconductors would be a little bit tricky if we fall back down underneath this previous bottom end of the range. Why? Just because we'll continue to have a lot of overhead supply. This will look like another instance of, okay, we looked in and now we're pulling back. This becomes more of a valid threat into the future. So I'd watch that out of semis. So you've got 237 overhead supply level. I would still in the short term say that yes, we are pulling back. Obviously, if this is a trend, lows, higher lows, soft higher lows, soft higher lows, soft higher lows on the gap up, highs, higher highs, higher highs, higher highs. Again, we're pulling back from the highest high. The hourly trend is finally flipped it down. It's possible that the daily chart could set a higher low. It's either over the gap or at the gap fill reversal. Once again, the only issue is if this happens, I would reconsider on this lower high here. And the place where it becomes most obvious is, let's just say that the market pulls back and then it rallies. If we get like a huge shooting star, upper wick, inverted hammer, whatever you want to call it, that looks like this, that would start to become a concern. Or if it's a little bit more sloppy, because, here's the deal, right? It's always easy to mark up a chart in hindsight, but in real time, that's where it's hard, right? So, of course, if this starts looking like, a little bit of consolidation, it's probably hard to call it in real time. But if the market gives you a solid red body bar like this, where you would want to be bearish is underneath this equal low at 225.50. right? So if this is too fast to respond to on an intraday or whatever basis, then your next major structural shift would be, okay, highs, lower highs underneath the low, obviously button it up. We're no longer maintaining the bullish stance. Again, speculative as of right now. The base case, let's just get back to base case for a shortened holiday week, uptrend seeking a higher low at the gap or at the gap fill reversal, 225.50. Let's move along to discretionary. Similar concepts over here, where if we pull back to close the gap, that's fine. Clean higher low over the weekly level as well, which I do like. So that would be 203.90, pulling back from the highest high. If we support and get some sort of acceptance back over 212.50, it's got to be rock and roll back to the equal high. That's supportive for the bull case in the S&P 500. Let's take a look at materials. Lightest weight sector for the S&P, chopping around in this range. Not an issue until we make a new swing high or a new swing low, breaking back below this 82.85, so neutral out of materials. Utilities, getting a breakout here. This is defensive, but it pulled back, right? So not an issue. Seeing these wicks, yeah, it does start to look like buyers are stepping up. It's a classic Brigade bolt over the top end of the range, 80.25. If we support there, fine. I mean, it's defensive, yes, but don't forget, upward pressure is still upward pressure for the S&P. It's just a matter of leadership when the S&P is making a brand new high, which we didn't do, so it's not a problem that it's down less, right? Let's move into communications. Easy opportunity for a pullback again. Higher high from here to here, higher high from here to here. Pullbacks over 98.60 look great. No issues. I think the main point, we'll save bonds for last. The main point is that none of these charts are overly indicative of, oh my God, the trend is changing right here in front of us. We need to flip to bearish right now. No, we've pulled back from highest highs and we're looking for higher lows to maintain uptrends, right? XLP, inside the balance range here, not breaking out. If it does break out, right, this would be my one caveat here. This does look good, right? Higher low over the moving averages, a retest of the high, Brigade bolt above. If that's what pushes the S&P to brand new highs relative to the local high back into the cluster, right? And the tech sector is not, emphasis, not performing, and the tech sector is continuing to pull back, the market's being led by staples, that's a red flag, right? So we'll just draw on a white flag because the red, the red crayon can come out. It's here. It's available. There's your red flag. If staples lead the market rally back to local highs, red flag. Okay, but that's just not what we're dealing with right now. We're dealing with pullbacks across almost everything. The S&P is on a pullback, and if we start to see the sector rotation get back in gear, where the stronger, heavier weight risk-on sectors start performing again, fantastic. Why would you not want to be long the S&P 500? Let's move into our ratios. We'll save the TLT for the bond segment of today's show. Let's move into ratios, though, for the sectors first. If you're not familiar with this type of screen setup, check out the video tutorial in the top right-hand corner. Key question to ask. This is like, if you haven't been able to tell the theme of the video, it's about seeking higher lows. So that's the key concept to remember here. This is risk on. Can it produce a higher low? Yes, it's pulling back from the highest high. Same thing here. This is financials. It's been struggling. We know that. We ideally have the structural chart higher low that's still available, but from a relative performance perspective, a little bit more neutral. I cannot call that outright bullish. We'll put a check here for being bullish from the highest high. Healthcare is not outperforming, so that's a non-issue. You can see here, consumer staples, not outperforming, non-issue. If we look at the XLU, still underneath that downward sloping or even just flattened out 50 SMA, it's a non-issue. So this still sides with risk on being the current view of the market. If we take a look at some specialized ratios in here, you can see the same thing. Leans risk on, pulling back for a higher low. Leans risk on, pulling back for a higher low, higher low, higher low, higher low. This all looks great to me. We could take a look at, let's jump into our B set. Gold has been on a little bit of a tear back to the upside. However, on the ratio chart, there's still an opportunity for highs, lower highs near the daily 50 on the ratio, as well as the neckline of the head and shoulders. So I'll be watching for that. If we look at the Sailor Shift tool, it's still on a green signal. We have not crossed through the zero line, even as the market out of Bitcoin, this is Bitcoin up here, right, has broken to brand new highs and pulled back a little bit. It wasn't the strongest breakout to end the week. I'm not sure what the over-the-weekend prices are doing as of Saturday morning, but for now, it's still bullish relative to gold. This is a risk-on indication. Remember, for me, Bitcoin will always represent a risk-on asset until proven otherwise via mass adoption or use case, aka utility. If we're looking at TLT relative to the S&P, highs, huge lower high, huge lower low. Even as both bonds and the market moved lower this week, you're not seeing a huge, quote, flight to safety in bonds by people buying bonds even as they're moving lower, trying to capture the higher yield. is not taking place. So the risk appetite for the market still remains strong based on all of these looks we've walked through right now. If we look at the dollar, it's rolling over here, which is helping fuel gold in the upward direction. If we just take a look at the gold chart before talking about rates, let's finish up the metal as a currency, right? You can see gold is rotating higher, but once again, where are we relative to these highs? Equal highs, if you want to call them that. We're underneath that, and the ratio of gold relative to the S&P is still underperforming. So I would certainly want to be an S&P long right now, not necessarily a gold long as a defensive safe haven. Even if you just want to use this as something that speaks to risk appetite, you're not seeing huge flight to safety. Yeah, the market pulled back. Yes, there's this little uptrend here, but we're still in an uptrend out of the S&P 500 equities themselves, right, is the key point. Let's move back to our rates and dollar combined chart. Dollar lower here. A lot of this has to do, I would think, with some of the downgrades ultimately out of the Moody's move from last weekend or last Friday. It was ultimately de-dollarization, if you will, currencies moving back home. That seems to make sense here. A lot of talk out there right now as well about the Japanese yen. If we just open this up, strengthening up here a little bit. It's not nearly like the yen carry trade, what we were experiencing here with that big shock, but it's a talking point for sure. So the yen carry trade could come back to some degree. I think everybody's well prepared for this. I mean, this first scare was like the first one where, oh my God, everybody's got to, basically, for lack of a better term, cover their asses. And now everybody's aware of it, right? So I don't think it's anything new. I don't think it will come to the market as much of a shock. Obviously, the Bank of Japan doing some firsts over there right now in terms of their rates and what's going on with the bond market. But for now, I think focusing on U.S. equities, it just looks like de-dollarization. We go 6E for the euro as well, and just take a look at that. You can see the uptrend here, obviously, as the dollar weakens a little bit, which makes total sense with the Moody's downgrade once again, people moving away from U.S. bonds, away from U.S. currency, back to maybe home. So in terms of interest rates, obviously the tariff news over the Friday morning session caused rates to move down, simply noting that the market's now concerned about what? Well, of course, recession narrative comes into play, growth slowdown. Oh my God, we're going through this again. So that's why rates are lower. But are rates like dramatically lower? Are they like what they were down here? No, not at all. So I still maintain the stance that there's really nothing to, I don't want to say nothing to worry about because that's a foolish thing to say in the market. But if we go to the 10-year on, this is a weekly chart now, down below of the 10-year, there's probably not much of a major concern unless you break out over the 4.6s and then start gunning for the 5%, 4.8, right, 5%. If that starts to happen, then markets probably get a little uneasy. And equivalent to this might just be if we look back to, remember we were comparing to the Fitch credit downgrade. When Fitch downgraded credit in August of 2023, that was back here, rates actually broke out to a new high. Well, when we got the Moody's downgrade, right, everybody thought, oh my God, rates are going to move like through the moon. We actually have not gotten a new high. Now, you could say it's early and it's just a matter of time and don't be a fool. That's fine. But until that actually happens, until we get a breakout through that level to travel to 5% on the 10-year, I think that, as we said in the intro, it's probably equities that are lying right now, and equities lower, rates lower probably spells, can we spot that high or low out of the S&P and look for movement in the upward direction? Let's quickly check in on the Fed funds, basically the 2-year. Inverted ZT is flat, so really not expecting much of a change or any new information out of the Fed watch tool. Let's take a look quickly. Yeah, nothing new here. Still 94% odds of a pause for the June meeting, which is going to be here in like the blink of an eye. That's crazy to think. Here's the end of the year, just making a note that we're still pricing in 2 rate cuts as of the Fed fund futures. But if you listen to Waller and Bostic speaking last week, they basically said, don't be shocked if you only get 1. So pretty firm in the telegraph on, higher for longer is going to persist, or just, pause. Let's look for more information, which I think is very reasonable. If the Fed's going to maintain the stance that they've really put forth over the last month and a half or 2, ever since the tariffs really exploded, we're going to need to wait for data to come in. The hard data right now is still great. We don't want to preemptively jump the gun and make a policy mistake by responding to data that was never going to roll over. So I think okay for now on the Fed watch. Last week, it was just a ton of Fed speak, which is why we could sort of speak to, again, Bostic giving some remarks there. I don't even know, where was Waller? Did Waller have his name up here? It doesn't look like it, but Waller was in the headlines, absolutely giving some of that information. Jobless claims last week actually came in okay. The initial, at least, that's the orange line down here, continuing to see a downtick. That's healthy. Initial jobless claims, continuing jobless claims back up and over. We wouldn't classically apply technical analysis to this, but back to a new high here, closer to this one. A little uncomfortable, a little hot on the continuing jobless claims, but not yet at a point where I think the Fed needs to respond. So I'll be watching that closely. The only other thing that we might pay attention to is the 4-week rolling average, seeing a little bit of an uptick here. If we just zoom out on this, go to a 5-year chart. Once again, very similar to the continuing claims, right? Sorry, not continuing, but rather initial jobless claims. Until this breaks out, the long-standing equal high set in here, where basically you could say the market has an equilibrium in the labor market, I don't think the Fed's going to respond. So yeah, in the short term, there's a little bit of an uptick happening here, but we're not even close to breaking out through those highs. So that's maybe a conversation point for that. The other thing we got last week into the end, Thursday, of course, was the manufacturing and services PMIs. Both numbers came in at the same reading, ironically, at 52.3, but they were expansionary, right? Which is not a signal that growth is necessarily slowing down here. If you read the excerpt from the services summary here, businesses received higher amounts of new orders in the period despite an aggressive drop in orders from foreign markets, which of course is due to the whole tariff thing. And if you look at, where is it? Softer demand for capacity drove service providers to trim their employment levels. So we know that's why we're watching this 4-week rolling averages and the continued claims moving higher. Again, not an issue yet, but we're seeing some soft data. This is soft data versus the hard data on the charts we were just looking at. And then on the price front, what we care about, input costs rose the most since June of 2023 amid higher labor costs driving out here. There it is. Higher labor costs, right? Higher labor costs. Does that have anything to do with tariffs increasing prices? Obviously, we're talking about services anyways. No. Higher labor costs. Now, you could say, oh, tariffs are going to increase prices, so people would demand a higher wage. You could go through that narrative, but this is, I would say this is not purely tariff related on the services side. And services we're a service-based economy. So you could dive into, if you really want, the let's just go back. Where would we have to go to this? PMIs. If you wanted to look at the manufacturing PMI, maybe there's an input cost driving that. But anyways, this higher labor cost, I think, is something that the Fed would key in on rather than the tariff input costs. So interesting stuff there, just a conversation to continue having. As we know, the charts dictate what we ultimately do, so let's not get too tangled up in that. As we look forward to the upcoming week's worth of trade, remember, of course, the market's closed on Monday. We get more Fed speak peppered in here throughout the week. It looks like Powell is speaking on Sunday evening. What else, though? What else is important? FOMC meeting minutes, probably not going to move the needle. They're not going to change much of the language there. It might be a volatility event intraday, but probably not a directional change. We have GDP numbers coming out on Thursday morning, jobless claims the usual, PCE, so some inflation numbers on Friday. That's going to end out, I should say, the month of May. Crazy to think about how fast May has gone by. It's been a quick one for me, but my God, has it been a grueling market to trade intraday with some of the lack of follow-through. Oof, pretty tough. Let's take a look at the earnings insight segment of the week. It goes back to one of the conversations we were having early on in this tariff conversation, which was all about guidance, right? We recall that what is really a major red flag is when companies say, okay, we're going to pull guidance because we just have no idea what's going to unfold. We don't want to guide strong. We don't want to guide weak. We just have no clue. Right? And that's obviously what we saw during the sickness. You could see this reference here where 185 companies withdrew guidance versus the tariff season, 8 companies withdrew guidance. Right? Crazy. Absolutely crazy. So in terms of the tariff impacts and like, oh my God, it's going to send the market into a downward spiral, we've gone through the downward spiral. Everybody knows what is on the table now. And as we've been saying on the channel, right, we have the MF over here, max fear. We have complacency somewhere in the middle. And over here, we have EU, the European Union. No, euphoria, right? The market probably moved from like complacency to here on Friday, right? It did not move to max fear. This is April 7th or whatever it was when Liberation Day happened. Friday was like maybe right here. And obviously the market rebounded intraday. So I think we're probably working ourselves back to complacency sooner rather than later. So that's my take, at least. Companies not withdrawing guidance from a fundamental perspective. It's not bearish. You could see here, right, equal to prior guidance, 64 companies raising guidance, 37 right? So non-raise, downgrade, as a matter of fact. So you're not in a situation where companies are like knee-jerk reaction, oh my God, let's withdraw it all and let's just button up and get under our desk and rock back and forth, stick our thumb in our mouth and say, oh my God, we don't know what's going to happen. No, it's not the situation. It's not the situation we're dealing with. This week's going to be a big one. We know it's all about NVIDIA on Wednesday after the close. CRM will be interesting as well. All eyes, obviously, on NVIDIA when they report, but some other honorable mentions perhaps in the lineup. Oh, what do we have? ANF is a good one, just to give a little bit of a sense for the consumer. Again, NVIDIA, Salesforce, of course, top watches in here. Sentinel-1 will have my attention, at least from a thematic perspective. If we look at Marvell Semiconductors, probably just going to move in sympathy to NVIDIA and then do whatever it does on Thursday. And maybe Costco as well. Not as interested in Dell. It's just a tough one to trade. ZS could be cool. And I think that's it. Abercrombie & Fitch is going to set the tone for Gap and American Eagle, I would have to imagine. So we'll watch out for that. The boxes get my honorable mention. Everything else, a non-issue. It's all about NVIDIA. If you could only pick one, obviously it's your top dog. The one stock to rule them all, NVIDIA. Let's get back over to the platform. Let's finish up today's episode of the analysis with some other technical indications, bonds relative to themselves, and then we'll flip back over to the TLT chart in just a second. You can see that the longer end of the curve is continuing to move higher versus the shorter end of the curve, which in my view continues to point out that maybe the market's concerned about, number one, it could be the inflation story. And someone actually sent me a great article, which I think was a reasonable article to send, that the market's maybe repricing some of the growth expectations and, coming into like the next wave of the AI boom. I don't know if you guys saw what was announced at the Google I/O conference, but the VO3 videos that are circulating online, unbelievable. So you could be thinking about, AI boom, wave 3, 4, whatever wave we're on at this point, pricing in humanoid robots in the future at some point. So that's one perspective, that the market's pricing in higher growth over a longer run here. So rates are going to move higher. Maybe. I'm still a little bit more partial to the uncertainty around inflation and the tariffs kind of driving the longer end higher. You also have some bond vigilantes, right? Just with the tax bill that's going through and bond players saying, nope, we're selling it all. We're, selling bonds causes rates to move higher, of course, or just demanding higher rates and not being willing to be a bidder until prices come down substantially. So pull the bid, and what happens? Floor falls out. You get bond vigilantes, I think, kind of driving what's happening there with the deficit spending, credit downgrade, and all that. So I'm a little hesitant on the growth narrative. I think it's a reasonable thing we can explore as markets continue, but this view here, in my perspective, kind of it leans a little bit more the other way. So that's that. Let's take a look at the TLT just to give you a sense of what's happening with the 20-year itself. So the poor auction on Wednesday causes that downside, right? Thursday gaps down, but then it's a recovery back to 85. This is a great spot for a lower high, then potentially lower out of bonds. I would still be, so FYI, anybody who missed the announcement, not that it's the biggest deal, but I've got some contracts short in multiple expiries out through June at the 80 strike and below. Happy to take assignment at a roughly estimated 5% yield down there, or just looking for a snapback out of the actual underlying itself. That's fine. Or if the premium expires worthless, again, non-issue. But it's a rinse and repeat trade, as we've seen some volatility on the Moody's downgrade thing. Obviously, everything that was going on with the Wednesday session. And the auction itself. So I thought it was reasonable to collect some premium on that at what I would dub sort of a decent location here at 80. Chart, though, does look bearish. Like, I have to admit that. Am I, technically being short puts is long delta. I'm long in a downtrend, ultimately. So I did just want to acknowledge it's exploiting the volatility really on the options contract more than anything else, but we do have a lower high under 85. That would be pretty bearish for TLT to, in my opinion, continue to the downside and get closer to testing some of those short strikes. 80 and below. 79, 78s were the others that were sold in there. So just worth a watch, but bonds continuing to move lower as the market's moving, moving lower. We had this conversation. I think someone's lying, and I think that markets ultimately start moving higher, given the higher low thesis that we've put forth. So let's get back over to these grids. Let's take a look at the credit spreads. A little uptick last week, fine on the Moody's downgrade. Not a shock to see that that's taking place, but are there opportunities for lower highs? Are what we care about in credit spreads? Absolutely. That would be bullish for risk appetite. As we move into HYG in isolation, this is your ding, 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 winner, winner, chicken dinner. What do we see out of this? And keep in mind that the HYG has been correct, basically, in forecasting this pullback for a while now. Notice the neutral divergence. You have an equal low out of the junk bonds on the Friday session versus equities, of course, making that lower low. Now, you could build the argument that, Matt, these things are massively divergent in the first place. Look at the distance between this. Look at the distance between this, right? It's not even close. Why are you making this comparison? Because in the short term, it's been more correct. This lower high, you could say, sort of foreshadowed the breakdown here. Is this equal low hold going to foreshadow the snapback in the upward direction? It's possible. Or the base case takeaway I would have from this chart spread is just that, okay, high yield junk is not breaking down, even if the equities market does continue to close the gap below or whatever, I would still be thinking as long as this maintains this, that's a bullish signal. So I'll be watching that quite closely. Let's move into the total breadth. Contraction, reasonably so, as the market pulls back. Anything concerning? Not really. New highs versus lows still over the 0 mark. It looks like 2 is the read on as of Friday's close. So not the end of the world. And once again, if this was like printing down here on the pullback, then, huge, like, oh my God, red flag. Not the case. Pulling back from the highest high, over the 50% mark on the 50 SMA, 200 SMA still has some work to do, but not overly concerned with that just yet. Sort of giving the market the opportunity to either support the 200 or the gap close and then reassessing, right? Let's move into our RSP. One thing I'll point out about this is that the China gap did already close on the Friday session. If this can maintain the hold and then Brigade bolt above, bullish for your S&P weighted down below. If you do see a continued move to the downside, just note how divergent it is from the S&P. If it's just a mild divergence, we move here and then snap back, no problem. If we're already at the top end of the tariff turmoil zone here and the S&P has still not closed the gap, that's a red flag. Let's move into our volatility metrics. The equal weight NASDAQ, by the way, is just 1-to-1 basically with the weighted NASDAQ, so we'll skip it. The VIX is perking up a bit on Friday. Not a shock. New tariffs. Not new, but just like another rehashing of tariffs. Fine. It's not enough to get back up towards like max fear up here. We could swap this out for VVIX, and you could see the same thing, not even close to max fear there. And if we go to the holy grail of all the volatility spreads, what we really care about is the contango on the vol futures, right? If you look at this, the white line is still over the 0 mark. Yes, it's made a move towards the 0 line, but it's over the 0 line, which means that the market's still pricing in. If I just show you via this spread over here, it's a bit of a different visual. It's still pricing in. This is the current volatility contract. The next volatility contract is higher volatility in the future. Market's pricing that out to July. And then it starts to taper off. We get a little bit firmer into a backwardation here. Ideally, this would look like this. Right? The point of this curve is that risk managers will be allocating capital in this condition relative to, so if this is bullish, this, of course, is bearish, like this. There's more risk in the present day. As I seemingly start to lose my voice as we hit the vol portion, let's take a sip of coffee here. We usually reserve this for the morning shows. Let's just move back over to here. We'll try to keep things going as we wet the whistle. There we go. This is bullish, right? I guess bottom line of the volatility through all of that is until this line actually flips back below 0, I would maintain a bullish stance on equities. Notice that you did not even break out over the top end of what I would consider the range out of the one-day VIX on the Friday announcement there. So if one-day VIX is under 2145, what's bearish? What's bearish about the market, right? It's not there. Let's go back over to the charts here. Let's give this a little refresh to our base layout, and then let's take a look through the core list. And then I've got 4 trade ideas for you. So NVIDIA, mild pullback up here. This is just a bull flag in an uptrend, right? If overhead supply can hold, right, zooming back out on the daily, we've been talking about this 129 quite a bit. This is a great spot for NVIDIA to hold back inside of this overhead range. If we could pull this back, right, Brigade bolt back in the range and then rotate back to the highs, fantastic. On the hourly time scale, there's quite I would think, 2 ways to get involved. Easy ways to, air quote, easy way to get involved. And keep in mind, earnings are next week too. So that does throw things off. Actually, I'm thinking to myself, oh, maybe this is a trade we pull off on Monday. Markets are closed on Monday. So we only have a day and a half until earnings here. So you might want to back burner active longs, shorts in NVIDIA, at least from an options perspective. Implied volatility is going to get a little bit nutty. What I was going to say, just from a pattern perspective, if you want to carry this forward for any of your other charts, if you could spot longs over 131, hourly high or low. If you could spot longs back over 132.75, range rotation, the target should clearly be 136.25 after setting the daily high or low over the top end of the overhead supply at 129. Beyond that, Brigade bolt over this is a bull flag breakout, right? We're not there yet, and again, earnings can just totally do whatever they want to the chart. We could have a big gap up, big gap down. We'll see. We know that so far the earnings cycle has been pretty positive. It'd be very interesting to see how NVIDIA reports and how the chart responds, noting it's already been on a little bit of a tear, right? If you think back to what Microsoft did, Amazon, all those big gap ups, right? They were gapping up out of the tariff turmoil zone into like this. NVIDIA's already made that move. So is it priced in? Are we going to get some flat action? It's yet to be seen. You guys know me. I'm not a fan of advocating for swing trades through earnings, so I will be flat NVIDIA. Other than the long-term account, of course, which has a multi-decade outlook, so all set on that. Let's continue along to Microsoft. What do we see over here? Daily chart looks great for a possible pullback into this 477. Or 447, apologies. I do think that this range has been difficult to trade. So I wouldn't fault you for saying, like, I don't really want to get long here and try to battle back up through this nonsense. It's the right spot for a potential higher low, but just whether or not the execution is clean, that's the different story that we really have to care about. So if this is a range, right, we're just trying to play range rules. Support the bottom, target the top, so on and so forth. The best clearance for Microsoft is, can we get over this local high? And then I think we have a quick trip to the all-time high, a date with the all-time high as the next forecast there at 468.48, right? If Microsoft breaks below 447, maybe you fish for the long here. I don't love that from the daily perspective. You would be underneath this previous pivot. I would think that this starts to become a little bit of a threat, one step at a time, but 439.50 would be the next major level. Obviously, this breakout point from the consolidation here post earnings. Let's move into Apple. I don't like Apple inside the tariff turmoil zone. I don't like it underneath this 201. I don't like Apple in here. So if this is going to say, it's a nothing burger, we're not worried about Trump tariffs at 25%, we're going to make phones domestically, whatever. If you get here, maybe that helps rotate back up to these highs. But for now, Apple is kind of a concern underneath 201. So rally rejections of 201 pressuring the broad market via a lower high probably signals some kind of gap close in the S&P 500, or at least a test of the gap in the NASDAQ. So I'd be watching 201 very closely. That is your must-watch level out of the Apple chart here. Let's take a look at Amazon. Amazon's drifting into the gap. Another one that's just been somewhat frustrating to find follow-through on. Like you would think, opening on a gap down here, gap fill reversal, there's some sort of short. No, gap fill reversal here, there's some sort of short. Not really. Daily 200 continues to act as support. Okay, we're going to rally over the daily 200. Nope, you're going to gap down below it. You're back over it. So a little bit frustrating, the price action in here. The thing that I'll continue to reinforce is, it might be frustrating to trade, but you can't get mad at the market. You can't shake your fist at the market and say, this is so stupid, and kick your desk and, do a bunch of crazy stuff. It's just like you either choose to play the game or you sit on the sidelines and you watch and you wait patiently until things clear up. So you can't hate it. What do they say? Don't hate the player, hate the game. You can't hate the game. You can't hate the game. You can only hate the player in trading, and the player is you. So be patient, look for good setups, execute them when they present themselves. If we hold over 225 cents, then maybe it's some sort of support off the daily 200. At this point, like the best response off of this would be like a hold over 203 to close the gap above. If you're like, nope, I don't even want that. I want to trade the gap, close above, fine. Yeah, that's really it. And I would think along the lines of the broad market here, there was no follow-through from sellers on the gap down under the 200 SMA. I actually tried a short at the 200 SMA on Friday. Excuse me, losing the voice. And that did not work, obviously. So no gap fill reversal out of this. Just not, shorts don't have it going on. So I don't think that there's any... I don't think there's a big short to close the gap here. I mean, maybe if you get this Brigade bolt, perhaps it starts to drift lower, but is there an easy trade? I mean, Amazon, based on the price action, has proven the answer is no. Let's move along to Google. I'm not fond of the chart. I actually gave this a firm reset on the levels in here. We've got all new levels to be working with that hopefully will clarify over the next couple of trading sessions. So this range, not interested in trading. If we're over the range, maybe it's a higher low. So the idea here might be if we could get a break over the Friday high 170. Love that. Thinkorswim on fire here with the round number on the initial click. Let's just change it to a gray line. There we go. Maybe a Stevie Wonder over the 170 back up towards these highs on a higher low. But obviously the pattern on the hourly time scale is just a head and shoulders. So underneath this, you rotate into the range. There is thin structure here. So maybe it's a short that does this. It's just been, harsh down on the conference, harsh up on the conference, up, down, like really, really tough chart, and that's really been the case for the broad market as a whole right now. It's been classically divergent intraday. As some of these up days, just massive negative ticks. If we just go back to the internals dashboard, now I'm getting a little bit tangential to the analysis, right? All the ticks on the Friday session as the market was rallying in here, big red ticks on Thursday, and yet what did the market do? Grind to the upside. So it's been a market that's somewhat hard to get a grasp on and like firmly have confidence in, okay, this is the move or that's the move. And again, going back to Google, I think it's a good illustration of that up, down, sideways, all over the place. It can't quite make up its mind firmly for the trend. I mean, obviously the trend is up. How do you participate in that when the moves are like straight up, then a pullback? Better hope you didn't buy the high. Straight up pullback, right? Better hope you didn't buy the high again. Hope you didn't short the low. You got blown out of the water. Oh, I thought it was a double top and we were under the neckline. Nope. Try again, right? So it's important to maybe note that the theme of the market, the context, the spirit of the market right now is one with a lack of follow through. It's a difficult market to trade right now, and I think you would probably want your size, your trading size, to reflect that, your position size, your selectivity in terms of setups, clean stops. If you don't have a clean stop, this is not the market for you. It's not a market to throw darts in. If we look at Meta, you get the same thing. Look at this choppy range doing nothing. Finally getting some acceptance lower on Friday. I'd be curious to see if we can stay under 630.75 to Brigade Bolt into the gap range down below. That's 621.25 to 605.75. That's interesting. Meta's clean off the levels. Just a matter of if it can get follow through now into the gap. So that trade here is maybe a top watch. If we poke into this overhead range, not interested. Let's move in. Obviously, this is where we play back on the long side through the thin structure. That's over 641.75. Tesla, relative strength, not breaking down at all as the market's been going through this pullback. So what do we see here? Bull flag persists. I mean, very simple. Textbook technical analysis 101. Patience. Can we get the swing? Remember, you don't have to get it right. All these fake outs. We've been comparing this to the daily 200 SMA break back here. Fake out 1, fake out 2, finally went and ran. When and if it goes, right, it's going to pay for the paper cut once, twice, 3 times, whatever, as it fakes out here, as it maybe fakes out again and pulls back. But when it goes, Tesla's going to have, one of those days, 3%, 4%, 5% in the upward direction up towards that 377, and that's going to be the payday. So I'm still watching this pattern. I think a lot of people are. I don't think I'm unique in calling this opportunity out, but Tesla, 350, 349, big watch to the upside. Great relative strength as all of this uncertainty in the market unfolds. Let's move into JP Morgan. Great gap fill to the downside, rallying and closing back inside the overhead supply there, or just, you could call it a mild pullback. I'm all aboard financials powering the next leg of the market higher if JP Morgan can produce this break of 262.25. If we get this, right, it's a mosquito pattern, and we're over the neckline there, the proboscis, at 262.25 into 266.50. 270 is the next overhead target. I like it. I like JP Morgan longs more than anything. Look at the daily. Look at the retest of this, right? Classic Brigade Bolt. Love it. Let's take a look at Netflix, another strong looking name. Consolidation up here near the highs. If it is going to turn into a bit of a head and shoulders, right, here's the hourly. It's got to be under the neckline firmly, 1183. If that happens, fine. Thin structure to retrace, but at 1160, I would also put my thinking cap on and say, where is the reversal back to the upside? Note the daily trend, right? You've broken out of this as a balance range. A balance range double has mostly been hit. If you could stair step over this, again, another classic illustration of the Brigade Bolt. If you support 1160, rock and roll. Let's get into these 4 trade ideas. The first one's going to be on Mickey D's. MCD is the ticker there. A little bit of a longer term idea, perhaps. Depends on how you want to trade it. What caught my eye was the inside bar on Friday instead of the gap down. If we can break the container bar high, let's actually come in there with a level. Let's go 316.50s. If we're over that, I'm looking for a move to the top of this range, which then you could start to classify as what? Ascending triangle. This is basically all-time highs out of Mickey D's, I do believe. All-time highs. So grab yourself a McDouble, and let's see if we can't break out over the top of this ascending triangle. Your next step would be a Brigade Bolt over 322, blue sky territories. Not interested if it stays below 316.50, goes sideways, breaks the daily 50. Not interested. If you want to, ideally, right, you could say risk, reward to get here, and then ballooning runners into blue sky territories. That's the early entry. The more confirmation entry is the higher low above, 322. That's Mickey D's. Again, grab yourself a McDouble. CrowdStrike gets slot number 2. What do we see here? It's an ascending triangle that's already broken out. Huge relative strength to the broad market. Possibly some love before the earnings announcement. That is on the 3rd of June. So we do have a week's worth of clearance here, a shortened holiday trading week nonetheless, but a week's worth of clearance over this, brand new all-time highs. There's 2 things that could happen here. The pullback goes to, let's go to the hourly so we can see it. The pullback has started, the consolidation has started over 455.75, blue sky territories, or if we pull back a little deeper, you could look for 250, or you could say, I want the confidence here on the next Brigade Bolt back up and over to 455.75. So either entry, this or this, I would entertain. Out of CrowdStrike, not interested. If we get a straight shot below, let's just say that Tuesday, we open and the bar looks like this. Not interested, off the radar, no dice, under 450, right? That's CrowdStrike. Let's move along, and there's no targets overhead. It's blue sky territories, so rock and roll. You're probably talking about 500, the round figure. That's the next big Jesse Livermore number. Let's move into MSTR, micro strategy, which is no longer micro, it's just strategy. MSTR, there we go. What's the idea here? Well, if we're going to get a little bit of a pullback off of, let's call it a double top, if this is trapped overhead supply, I'd love to see some follow through. I'd love to panic out some of those buyers, and we'll be waiting patiently at the double bottom neckline. Another classic illustration of, you guessed it, the Brigade bolt. Trademarked, registered, and copywritten. Don't make me get the lawyers on a holiday week. They'll charge extra. 341.75 is your big watch. Daily 50 SMA is confluence with that neckline. If the pullback continues, I would be thinking, can we get an initial reaction long on that move? Of course, the daily structure has to set up for it. Hammer or something in here, some kind of doji, some kind of intraday double bottom, right? But 341.75, huge watch on the pullback out of MicroStrategy, which is now just strategy. Thank you, Michael Saylor. Let's finish it up with another interesting ticker, XYZ. Anybody know? Block, the old SQ. Bull flag, very classic, right? So here it is. Earnings are in the rearview mirror, supporting that daily 50, curling, right? Looks good. Over that 59.60, a cheaper price point here for us. If we could get something that looks like this, thin structure retracement into the local high at 63.25. Here it is on the hourly time scale. Nice balance range, clean relative strength on the Thursday and Friday sessions. Brigade bolts out of 59.60, 63.25 becomes your target. Not interested if we break the daily 50, which is roughly in here at 55.50. Let's make it gray, and we'll end on that note. That's going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new in today's episode, let me know down below in the comments section or by giving the video a very simple thumbs up. We may or may not do some kind of, Q&A analysis stream at 8 a.m. on the Monday session. We will see. I might be a little partial to taking a break from this wild market, taking the day and relaxing. Maybe we do, maybe we don't. I don't know. I have not decided yet. Depends probably on what the weather does, if I'm being honest. And we'll take it in stride from there. So maybe look out for something, maybe not. We'll keep you posted over on X. If you're not following us on X, it's at Trade Brigade Co. No spaces, no dashes, no periods, no underscores. Make sure you are following the real Trade Brigade. There is some imposter out there who's been lurking the last couple of weeks. We're doing everything we can to take care of it. So with that, enjoy your long weekend. We'll see you maybe in the office on Monday for some Q&A or whatever, some analysis, ticker requests, maybe not. But we'll definitely see you on Tuesday, 8 a.m., back in the office, pre-market prep, full steam ahead, tackling the week ahead. With that said, have a green trading week, and I will see you in the next one.